that 73% of small and medium enterprises in India, they did not make even a single rupee profit in the financial year 21. Hi everyone, welcome to today's video. So first and foremost, I would request you to take a look at this particular snippet. It categorically shows that back in 2020, Zomato fired 13% of its entire workforce. The reason was cited as coronavirus pandemic, that difficult situation, we have no other option but to fire the employees. You would ask that, okay, hey, Zomato fires, how does it impact me as a stock market investor? Very important lessons there, because if you would have invested in Zomato this year, you would be sitting on a loss of 40% on that stock. And if you would have picked up this basic cue from the employment sector, you could have easily avoided a company like Zomato and saved that money. Something very similar is playing out right now in 2022, that a bunch of companies are struggling in the Indian economy and they are very likely to go down now. So we are going to have two levels of conversation through this video. One, I'm going to talk about this Zomato story, and I will also relate it to the Indian economy and what type of companies are struggling in the Indian economy right now and why. Second key important point, that if you are a stock market investor, what type of stocks you should be selling or at least not buying in this current economic scenario. So let's get that discussion started, and a very quick shout out to our knowledge partners for today, which is Kuku FM. It's an excellent audiobook platform. I absolutely love using their product. It's an excellent knowledge enhancement platform. You can listen to audiobooks, podcasts, and a bunch of related things. You can also listen to the summary of books like Coffee Can Investing on the platform, which can enhance your knowledge and make you a better investor. They are running a 50% discount right now for the Holi special. The offer will be available till 20th of March. So you can use the links in the description box to get a 50% discount. So let us get the discussion started today. And first and foremost, let me take you to my Twitter timeline. In case you're not following me on Twitter, humble request, please follow it. You will learn a lot of things I literally teach via Twitter threads. So first, via this Twitter thread, let me help you explain what type of companies are likely to suffer in 2022 and why is that? That is more important. So this will help you plot an economic landscape of what type of businesses to avoid. So let us very quickly go through this thread. So first and foremost, back to the Zomato story, that back in 2022, Zomato fired 13% of its entire workforce. The reason was cited that, hey, coronavirus pandemic, we have to cut out our workforce. The problem was that Zomato was one of the most well-funded startups at the time. It was a unicorn. It was a celebrated startup story in India. And if that company, which is a leading unicorn in India, one of the largest tech players and whatnot, if such a large startup is firing so many people, then of course there will be subset of startups which are poorly funded. They will just go to dust. Right? So with that point in mind, you must understand that whenever these COVID-like situations or 2022-like situation happens, only resilient companies survive. So if you relate this to the current crisis, what is happening in the current 2022 crisis is that there are both demand side and supply side issues that are getting created. For example, from a supply point of view, India is a net importer of oil. Almost 20% of our import bill comprises of oil. So as a result, if the oil prices are very, very high, and if India has to import it, India will get access to fewer barrels of oil. So we will import less. That creates a supply side issue for the Indian economy. Now, on top of that, there is high inflation issue and there is disruption of supply chain. Due to Russia-Ukraine war, the inflation has skyrocketed. I have made earlier videos, you can watch it here. And also there are supply chain constraints. For example, a lot of companies want to manufacture things in India, but they are not getting access to raw material. So there is a supply side issues that companies are grappling with. Now, this supply side issues become even more prominent for companies that are getting stretched. For example, you might have heard very recently, a couple of months back, that there was something called a semiconductor shortage that happened. Now, semiconductor is used in a bunch of different things. For example, right from automobiles to electronics, semiconductors is used. So some small manufacturing firms will definitely get stretched due to these semiconductor shortages, because semiconductor shortage was already there and Russia-Ukraine crisis has further accelerated it. So this was about supply side. Now, what about demand side? Demand side simply means that there is less demand for goods and services. People are not demanding goods because things have become so expensive. For example, according to several estimates, the inflation in India is likely to be around 6 to 8%. Some estimates are also saying that inflation in India can go up to 10% also. That will skyrocket the price for literally everything. Even before this current breakout of crisis, the inflation in India was gaining more prominence. Some companies like Asian Paints, HUL, already increased their product prices. Now going forward, this increase in price hike will continue to happen from company side, and as a result, it is estimated that demand side constraints will also come into the equation. Now you'll say, okay, supply side issues, demand side issues, issues, and there are like so many bad things happening in the economy. So what exactly is the implication of all this? All right. So basically what happens is that under such high stressed environment, leveraged or high debt firms that have taken a lot of debt already, they struggle, because if the demand dries up even for a few months, you still have to pay loans. If I have built a startup on loan, or if I run a company that has a lot of loan on its head, it becomes a very stressful situation for me, because I am still liable to pay my loans, whether the economy is doing well, whether the economy is doing poorly, whether there are supply side issues, whether there are demand side issues, I still have to pay my loans. So high stress environment creates a lot of problems for these leveraged or high debt firms. So if you have high debt firms on your portfolio right now, you should become really careful about holding those companies. Now, why am I saying it and why am I scaring you? The reason is fairly simple. There was a study that was done, and the stats of that study was that 73% of small and medium enterprises in India, they did not make even a single rupee profit in the financial year 21. Please note that the 2020 COVID crisis happened in financial year 20. So basically, any crisis creates a lingering on effect. So COVID crisis happened in 2020. It stretched towards the mid of 2021, and in the financial year 2021, that is when majority of these SMEs struggled to survive, so to say. Now you might ask me that, Akshat, can you explain systematically why does this happen? Why is it that these small and medium enterprises suffer a lot? Why do these small companies suffer a lot? Why do these high debt companies suffer a lot? So let me pick an example. So for example, you might have heard that government runs something called as PLI, Production Linked Incentive Schemes. Your assumption would be that these PLI schemes would be availed by small companies because they need a lot of hand-holding, financial support in terms of running their business. But here is an article for you which categorically says that 42 firms like Daikin, Panasonic, Syska, Havels, with commitment investment of 4,614 crores have been selected for PLI schemes. So you can clearly see that actually big companies end up availing benefits about these PLI schemes. So as a result, companies that are already struggling, these small micro players, they continue to struggle in bad environments. So in case you have your investment in these small micro players, they are high debt, super stressed, in bad industry, please exit this stock, even if you have to exit it at losses. The reason there is fairly simple, that these type of companies are not going to come back up after witnessing 2 successive crises. Now, drying up of startup funding is a great indicator, or it's a very worrying indicator, so to say, about what is going to happen in the industry also in India. So right now, the startup industry's funding is drying up, and let me explain you why that is the case. So if we go back to that Zomato story, you will quickly realize that majority of the startups in India are not operationally profitable. What is meant by operationally profitable? That, for example, Zomato or Paytm, they make a lot of revenues, but they are not translating that into profit. For example, if I'm selling this pen for 100 rupees, I'm making a revenue of 100 rupees. But if it takes me 110 rupees to sell this pen, then every time I sell this pen, I'm making a loss of 10 rupees. So yes, I'm making revenues. My revenues are growing, but I'm not growing profitably. There are no operational profits for me. And that is the story of majority of the startups. So what do they end up doing in order to survive? They move from Series A to Series B to Series C, Series D. Series is simply mean that you are raising more and more money in each round. And then you pick up this money just to survive. So you might have heard right now that a company called as Better.com and Lido Learning, which had massive funding. So Lido had to shut down entirely, and Better.com fired a lot of people in early part of March in India. What does that indicate? It indicates that these companies are struggling to get their next paycheck in terms of raising money. What does that in turn indicate? It indicates that these big fat investors have their own issues to deal now. They are changing their investment mode from growth to defense, and therefore they are pulling out money for startups, and this is not great news for industry, especially for high stressed, high debt companies. Now you might say, Akshat, you are giving like negative news. Earlier you used to be so positive, full of life, all good things. Now you are saying like such bad things about everything. You have suddenly become bearish. We don't like it. No, I have not turned bearish. I am still bullish, and I am investing heavily in the stock market. But there are certain types of companies in which I am investing, and I'm making these videos to forewarn you to get out of certain bad companies. And why am I making this video? Very simple, because leveraged firms will get shut. Strong firms will take away their business. So that is a simple model that will happen, that fittest firms will survive and they will make crazy money by taking away the business from weak players that are highly leveraged. Now, before I talk about the stock market actions that you need to take, I will briefly comment on the career actions that you also need to take, because many of you, if you are working with startups, you might end up in a very bad soup very quickly. So please go network, please get a few offers, build some backup options right now, because if you're working with startups or small enterprises, the survival is not given here. If getting another job is not an option, please learn some monetizable skills. An example would be video editing. So you can easily make 40-50,000 a month by by doing video editing, and this can be learned very, very quickly. So identify such monetizable skills. It's very important for your career right now. So there are 4 specific type of stocks that I will be selling, and I will definitely not be taking fresh positions in these type of stocks. So the first category is the stocks that require fresh R&D money. Now what happens in high stressed environment is that a certain amount of rebuilding happens. A classic case in point is the EV industry stock. Now in order for EV industry to come at scale, you require a lot of R&D money that needs to be poured by automobile companies to launch new models, do a bunch of different things. But if R&D money is poured excessively, and if not enough buying is happening at the back end due to demand side issues, then there will be an economic squeeze situation that will play out, and it will be very, very bad for the entire industry. So I am not taking any fresh positions in EV type of companies. I have already been saying it for a while now that I made very little investments in EV industry sometime mid last year, and I have not taken any fresh positions hence. Why? Because R&D money gets dried up very, very quickly, and the spend on R&D, if it becomes quite excessive in uncooked industry like EV right now, where price points are crazy, you stand to lose a lot of ground if demand revival does not take place. So I will avoid these type of companies, for example, Tata Motors, etc., right now. Second key point, if the company is small, medium, plus it has high debt, I will avoid these type of companies. Now I will not take names. You just simply go and check the debt to equity ratio. If you go check it, and if you find that the debt to equity ratio is more than 10-15%, please just simply avoid that company if it's a small cap or a mid cap company. That's the second key thing that I will recommend. Third key point, please avoid story-based, no-profit firms as of now. It's a very dangerous scenario simply because of the fact that we have moved towards a region where the markets might move sideways. Demand revival might take time. So please invest in companies that are actually making profits. If you go and invest in companies like Paytm just because they are trading at a discount, it might still be a very, very bad move. So please don't do it. Please be careful in these type of companies. If I had something like Paytm, I will just wait market to recover a little bit and I will sell it off. Then fourth and finally, I will not play around with commodity stocks except for steel. Why steel, you might ask? Because whenever the industry revival takes place, whatever the pent up demand for steel is, it will anyways get absorbed. So steel is okay for me. I am still holding it. I am not selling it off. Any other commodity stock, for example, gold, just because it has become very high does not mean it is going to continue to make new highs. It's just a spike. Similarly, oil related companies, I will not hold any. I will sell it off. If you have oil related stocks in your portfolio, perfect time to sell it off. Why? Because these commodities have just jumped up in prices simply because of the supply chain disruption that has happened due to the current war. That is the reason why these commodity prices and commodity stocks have gone up as of now, but I would generally avoid. Please take all these things as discussion, not a recommendation. It is your prerogative what type of companies to invest versus not. It is your hard-earned money. I am just sharing my understanding with you. I would rather go and invest in fundamentally sound companies that I'll be okay holding for the next 3-4 years, where the business loss is not going to happen. They are still cash making, they are still generating a lot of profit, and they have branding and pricing power. So even those type of companies are easily available as of now. So there is no point in me trying to get fancy in terms of purchasing commodity stocks or buying high debt companies in this unstable environment. I hope you enjoyed the video. Please press the like button and I will see you tomorrow.